The Greeks don't explain everything. They are vital signs on a patient, like the heart rate, blood pressure, temperature. They are useful, but they don't capture emotions, sudden shocks, or rare events. Welcome to Financial Flywheel, where we encourage and support one another to design, nurture, and run your own financial flywheel that can take you closer to financial freedom. Today, we will have a look at these Greeks and understand them in the context of nifty options. The same principles apply to global markets too, and it can be taking the underlying as commodities, stocks, or index traded in those markets. Our intention is to develop mental models for the Greeks so that we design options based on models that can use the right tool that serve our purpose. The discussion comes under market analysis and tools. This knowledge will help us inch closer to gaining mastery in the domain of FNO. How to view the significance of Greeks and look at probability distribution function? Let us look at it through a lateral analogy. Greeks like delta, gamma, vega, theta, and rho. As we discussed in the beginning, it is like blood pressure, pulse, oxygen level, say just-in-time sugar levels. They are instant readings of how the body, or in this case, the options position, respond at this point in time. However, if we look at standard deviation, um, it is something more than that of capturing what is happening at this point in time, but it is more like a forecast of how the health risk assessment or a stress test can be for the model that we are considering. In the human world, we can think of it like a ECG, treadmill test, or a cholesterol profile. It doesn't tell us how we feel right now, but it can give us a probabilistic range of where risks could lie in the future. In the options world, the 1 sigma range of outcomes upwards or downwards are expected with 68% probability over a given time. It's the probable boundary around which our Greeks operate. And hence, we need to design our model that is standard deviation compatible and friendly. So while Greeks answer, if the market twitches now, how does my position respond now? The standard deviation will answer, how much twitching should I reasonably expect? And what's the safe zone and what is the danger zone? Notice that is why probability is a much more important aspect of our design, and we just focus on the Greek will lead us to a myopic vision of the outcomes. The Greeks are the present tense, and the standard deviation and the probability distribution are how the future looks ahead. Okay, with this introduction, now let us look at how does theta come into play. So for this session, the theta aspect is all that we are going to discuss. There is another cousin of the Greek of theta called Vega, which we will not take up in this discussion, though the same points of consideration would come for Vega. For every option premium, what is premium? The moment you look at the price of a contract of an option, the market will make it available at a particular price. Whether we buy it or sell it, the price is determined and is present in the market in real time. The option premium can be dissected and it will have two phases, an intrinsic and an extrinsic value. This is a very important point. The intrinsic value is the real meat. It shows up when the option is in the money. If it is not in the money, the intrinsic value will be zero. How we will look at it in example of a hypothetical situation. For example, let us say there is an underlying and the strike price of the current market price is, let us say, 100. So it's $100 paid. So if you look at the example given, the bar chart shows the ATM strike is 100. The example probably taken into consideration is that of a call option, because if the contract is sold at 95, then when the market price hits 100, then there will be two values: the in the money value of yellow in color, of blue in color, which is the intrinsic value, and the yellow value, which is extrinsic value. So what this really means is, the strike price is 95, the current market price is 100, the market has gained by $5, 100 minus 95. If this was the US market, then the lot size is 100, and assume we had one lot in this play, then in theory we would be making $500, and the blue intrinsic value actually captures this $500 in value. So what does the yellow value capture? We know that an options contract also has a time to expire. This time to expire will have its own play to add to the premium. The yellow color that we see over here in this bar chart is that amount of premium that comes into play. So when the market is in the money, which is in this particular case, because it's a call option, and whether the person has gone long or short, the option is in the money because the market has gained to 100. So $5 worth contract is $5 worth market is already captured. The remaining yellow color is the time to expiry. Assume that it expires in, let us say, 2 weeks. Now we'll look at the money. The current market price is 100, and in this case the strike price is also 100. In this context, what would happen? What would happen is, the value of the meat of the contract is actually 0, because there is the strike price as well as the current market price are exactly tallying. So the net value of the premium would only be the time value or the extrinsic value. Now we will look at a contract which is further away, which is out of the money, which is $105. Because the current market price is 100, this contract strike price is 105, there is no value of the underlying that is getting captured in this contract, and hence all that we see over here is the time value. There is a very important distinction between theta and extrinsic value. Most of us while trading might mix the two, thinking and saying that extrinsic value means it is just time value. However, there is a very important aspect to the extrinsic value, and that is that of a volatility value, which is called as a Vega. The same discussion that we are having now will come into play when we discuss Vega also. But at this point in time, we will not be discussing Vega. But it is important to note that extrinsic value has both these parameters, theta as well as Vega. Theta is the rate of decay of the extrinsic value with respect to only time. So if day passes by, the value of the premium will come down. To what extent it will come down per day is what the theta captures. assuming that the market is stable and the current market price remains as it is. Okay. Now, let us look at in a famous probability distribution function fashion of how we evaluate models and mental models. Notice that it's a time value, theta, and the bell curve that you see over here is what represents the market movement of an underlying. In this context, it is the US market of any underlying. Let us say the current market price is $100, and we have three contracts, like the contracts that we discussed in the earlier slide. There's a $90 contract and there is a $110 contract, and $90 is in the money, $110 is out of the money. So this is a call option contract. We have bought three contracts, 90, 100 and 110 say. Normally in real life, what do we see? As the time passes by, whether we are in any part of the world doing whatever activity, if 5 minutes are passed, then 5 minutes are passed. There is no ambiguity there, correct? But let us assume that we are doing something very interesting. Then when time, we will have a relative feeling that the time passes very quickly. And when we do something very boring, we will think that the time is taking more, it is taking more time for us to accomplish the task. In a similar fashion, the contracts actually behave in a very peculiar way when it comes to theta, when the contract is in the money, out of the money, or at the money. The reason for this is nothing to do with the theory of relativity. The reason that this comes into play is because how the delta, sigma, gamma and theta have been defined in the Black-Scholes model. So the premium, which has the time factor alone, is being considered in this bell curve. And what has been observed is when the contract is at the money, the time decay or the theta effect is maximum. The parallel that one can draw is like that of watching a movie for the first time by the audience, and there is absolutely no idea whether the movie is going to be a hit or a flop. If the movie is a hit, then the value of the ticket bought at this point in time will, whether it is a hit or a flop, at this point in time, because the movie is in play, the value of the ticket gradually reduces. If it is like a 1.5 hour movie, within 1.5 hours, the entire value of the ticket is lost. This is the example for at the money. Because nobody knows how the movie is going to be, it is very difficult to get an additional money by selling this ticket to someone else while watching the movie and exchanging a seat. So the entire premium or the cost of the ticket is practically going to go to zero when the movie is at play. Now let us look at an example or a mental model for in the money. Assume that it is a movie or a concert ticket of somebody who is very eminent and popular, and the track records are phenomenal. And we have this ticket which is say 60 days in advance. So chances are that as the time passes by, the value of the ticket can actually go up. That is because people already know that the content of the program is going to be phenomenal and it can never be duplicated. This is the model that one can keep in mind when it is in the money. So what happens is, when the market is in the money, as in this particular case, it is $90, and let us say the time passes by and the market moves towards, say, $100, you notice that if we had bought the contract at $85 and $80 strike price, the effect of the time getting lapsed is lesser and lesser. Is it not? The $90 is the current strike price. If we compare it to $85 and $80, as the time passes by, the value or the effect of the time being passed is lesser. That is because the inherent value is already captured in the ticket. Now, this is a direct contrast to that of the out of the money contract, which is at $110 call option. One can view it as if it is like we having to compare, let us say, two data plans that we are getting today. One data plan expires in 1 week, another data plan from the same vendor expires in 1 month. So as the day passes by, whether we use the mobile phone or not, the value of the plan, the rental, will slowly start eating away the amount that we paid. So this can be the mental model when we look at OTM. And again, what we are saying, again, this is real data. If we look at and analyze the real data of how time value or theta operates, we will notice that the further the strike price, in this particular case, it is the call option, further the strike price, this is also, by the way, also valid for the put option. So if it is like $115 and $120 call option, what we are saying is the effect of time value is actually lesser than that of $110 or $105 when the current market price is $100. This has been the observation, and this is the way the Black-Scholes model has come up with the way theta operates. So to summarize, theta will tell us how much money the option premium loses each day, just because the time is passing by. Again, in terms of notation, it is always negative for long options and positive for short options. The reason being, if it is a long option, as time passes by, the value of the option will come down, just like the mobile data situation, and hence it is going to be negative. And if we had sold the mobile data, if we are a vendor who sells, it is positive for us because as time passes by, that much of premium we are capturing. Okay, there is also one more important aspect of how theta behaves at the money. This we will come back to even for Vega. The largest erosion in magnitude happens for at the money. The reason being, there is no underlying meat that is captured, no underlying value. The movie is already in play, and there is no anticipation. People don't know. So even if you try to sell it to somebody, the value would be significantly lower because the audience have no clue what to expect. So that is the mental model. And in the money and out of the money, the erosion is the least, and that would take a shape of a bell curve, as indicated in this graph. Also notice that the tail ends, which means that towards expiry, the time value really melts fast. Okay, now we will take a real example. This data has been taken from Sensible. Let us say that there are 13 days to expire, and the Nifty index, Nifty we will take in this discussion, 25,050 is the 0.55. Since we bought all these contracts, the theta value is calculated as negative, since the net potential profits will decrease as time passes by. If we had sold the contracts, the value would have been positive. In this slide, we want to bring the distinction between extrinsic value and theta. Again, unfortunately, the way the tool represents is, it first lists 24,300. After that, only it lists 24,700. Though it would have been great if it had listed 24,700 and 24,300, because then the bell curve can be easily imagined. The current market price is 25,050, which is at the money. Notice that the extrinsic value is maximum, 157.4, and theta is also maximum, which is 7. Let us look at only the magnitude, because the significance of the notation of the polarity we already discussed. Now, as the market falls, market will fall at 24,700 and then only 24,300. So 24,700 has a higher theta compared to that of 24,300. In a similar way, because it is a put contract, if somebody had, let's say, in this context, bought at 25,800 or 25,400, it would be in the money, capturing a value of, let us say, 25,050. So around 400 or 350, and in that particular case, in the case plus 400, 750 or 25,800 respectively. So what we notice, deep in the money, the magnitude is 2.6, but just in the money, it is 6. Again, this is consistent with what the black scholes have taught us, that it is a bell curve. And at the money is the maximum, which is 7. We are also looking at the extrinsic value in the right-hand side column, if you notice, which is 60.25, 20.7, and 150. 60.25 and 20.7 are exactly the premium value, because there is no meat in it. There is no inherent value. But if you look at it at the money, again, the premium is 157.4, extrinsic value is also 157.4. That is because there is still no meat, and this entire thing is a time value. Now, as the market becomes in the money, the extrinsic value is lesser. That is because the premium is actually, the intrinsic value is already captured in the premium. And the further away the market is, which is deep in the money, in theory, the premium should have, extrinsic value should have been lesser. But in this particular case, it is more. I have just chosen to leave it as it is. That is because as a trader, there are liquidity considerations. So when we look at this data, there is always a bid and ask. Unfortunately, for certain strike prices, and especially when it is in the money or deep in the money, the bid and ask will be very varying. The spread will be high. And hence, we find this disparity. But in reality, if we have to actually do a trade, we will not be able to, most likely not be able to get such a high extrinsic value for this contract. Okay, with this we will summarize what we discussed today. So in conclusion, we should note that the theta is a silent enemy for every option buyer. It erodes our premium a little every single day. This time decay is fastest at the money, slower when options are deep in the money or out of the money, and the shape of the decay is that of a bell curve. We can look at time passing by as if it is a melting an ice cube. So that is the way we can look at it in absolute terms, in a mental model analogy of how time really operates. Option sellers benefit from theta, while buyers must fight both direction and time. Why this point is because as time passes by, the premium is going to come down, the theta aspect of the premium is going to come down. And next is, assume that you are in the money and the market is going to move outwards. Then we will have to fight that also, because when it is in the money, it is, at least we are able to get some premium out of it. So that is the struggle that an option buyer will have. Remember, theta never sleeps. Even if the market doesn't move, the clock still ticks. The real lesson is that trading options, we automatically know time is money, and theta will always take its share. So with this, we would like to thank you for your time, and good luck for all that you're doing. Until we meet next, bye for now.